Good morning, everyone. Welcome to this update for global stocks and commodities for the 20th of November. And another extraordinary week in all asset classes around the world. And what is becoming obvious is that we have got some very big picture, long-term changes, things that have been in operation for several decades in the case of the bond market and interest rates falling, and also central bank policy, which has been to exercise monetary stimulus for many, many years since the GFC, now seems to be shifting more towards fiscal spending by governments rather than central banks trying to inject money into the economies, which clearly hasn't worked. Now, the consequences of these big picture changes, which are going to continue for a long period of time, these aren't going to be just short-term blips. These will go on for quite a period. The consequences of that, and the fact that what Trump is going to do in America, or what he's going to attempt to do in America, is not going to change anything in the bigger picture. These changes were going to happen anyway, but the impact of Trump is going to be to accelerate the changes that were going to happen anyway. And all of this adds up to a whole series of unintended consequences, some of which can be anticipated and some of which can't. And that's really the essence of the investing environment that we find ourselves in these days, that there are some things that we can expect to happen, but there are many things that we're going to have to factor in which are uncertain and unknown at this point in time. So I'm going to do my best to try and walk you through some of the consequences of this without getting too technical, as I could quite easily. So I'm just trying to present it in a way which is relevant and understandable for everybody. So as usual, we should never look at the markets without being able to put it into context. And so this is the bigger picture backdrop of what's going on around us. I think the last couple of weeks have really shown that the biggest change in the investment climate since the GFC is now clearly underway. The bond market started turning in July, so it's not a function of the Trump elections or even Brexit. That was already happening. So we've been through a 35-year decline in interest rates from, you may remember, up around the 16, 17, 18% mark, and we got down to 1.5% in Australia, virtually zero in America, and negative interest rates in Europe and Japan and a few other places. The US dollar in the last 2 weeks has surged the most in a very short period of time since Ronald Reagan was president, and that's a long, long time ago. And what is happening, as I said earlier, is just part of a change in the long-term cycles. It was always inevitable. The second point that I think is worth acknowledging and could have quite significant impacts is that we've seen the impact of nationalism and anti-immigration sentiment in certainly in Britain, but to a degree in America. So we're seeing the impact of the populist right, and we've got several elections coming up in Europe in the next 6 to 8 months. We've got referendum in Italy very shortly. We've got elections in France, we've got elections in Germany, and we've also got elections in Austria. And if there's any follow through, as we've seen from what's happened with Brexit and with Trump, particularly in France and Italy, then that places the whole Eurozone in danger, because those populist right policies could very well result in either Italy or France or both exiting the euro, and that would be an absolute game changer. So there's certainly that's one to be watched, and it's all going to unfold in the next 6 months. The other point that I think is worth highlighting is just some of the craziness that we're seeing in some of the markets at the moment. And I'll just point out one and show you a chart. And that's in the last couple of weeks, we've seen this extraordinarily crazy situation where the value of what you would regard as safe bonds, not that I like any bonds at the moment, I think it's the wrong part of the cycle and has been for a couple of years. But safe bonds, and I'm talking long-dated US 20 and 30-year treasuries. So they would be about as safe as you could get in terms of getting your capital back. Now, the value of those bonds has fallen through the floor, as we'll see. And yet corporate junk bonds, which are the riskiest bond, highly likely to default, and yet the yield gap between those two has narrowed dramatically in the last 2 weeks. Now, that makes absolutely no sense. That people are now saying, well, we actually are prepared to take very, very small premium to own real junk quality bonds as opposed to a 20 or 30 year US government bond. That's clearly unsustainable. So let's just look at that chart because I think that's a really interesting one. So you'll notice here we've got 2 lines. The blue line is an ETF called TLT, which is an index that tracks US 20-year and beyond maturity bonds. And you can see just how much TLT has plunged in the last few weeks. The green line is another ETF, which is HYG, which is the corporate high yield and therefore junk bonds. So these are corporations that have the lowest credit quality or the highest default risk, if you like, and therefore have to offer a higher yield to attract investors. And it's hardly moved. It's down a little bit in the last couple of weeks, but relatively speaking, it's hardly moved. So that means that the return that investors are prepared to accept from junk has got a lot closer to what they're getting from gilt-edged government. And that's just one more example of the stupidity of how market pricing is being forced. Now, there's a reason for that, and that has been scratching my head for a couple of days as to why that's been happening. And I've done some more digging, and I've found out really what the explanation behind that situation is. And it really gets down to the fact that around the world, this might seem like a strange thing to say, but around the world, there is a shortage of US dollars has developed. Just to give you step you through a quick bit of history first, so hopefully you can understand this a little better. We've had 5 decades of accelerating credit expansion since the 1970s, since Nixon took the US off the gold standard, and lending became progressively more and more risky during that period. We've now reached a situation where some of the sources of liquidity, particularly from the global commercial banks, are now drying up. Commercial banks are now withdrawing from some of the markets that they used to function in and therefore provide a great deal of liquidity. And what that has meant is that countries other than the US that have substantial debts or trade imbalances are now being forced to sell their US Treasury holdings because they've got to raise US dollars because there is a shortage of them in relative terms to basically run their economy, to fund imports and to service the debt. So for them, it's not an option. And so what has happened is that the US Treasury market has been selling off, and that's why we've seen TLT go down as much as it has. And that has been fueling the rise in the US dollar as well. So it's not that people are flooding into the US dollar, it's the fact that they're having to sell their treasury holdings to basically raise US dollars. And so when you understand that, it becomes a lot more understandable, I guess. But the point about it is that it's causing US government bonds to rise, and they've risen very sharply. The 10-year yield is up from 1.36 just a couple of months ago, and now it's about 2.35. So it's gone up a full percentage point. And so you then can say, well, what's the cost of servicing the world's global debt, which has been estimated at around $200 trillion. So if government bonds keep rising at this rate, then the impacts, and again it comes back to the title of this presentation, the unintended consequences, some of which we can anticipate, but many of which we cannot. So it's certainly a brave new world. Now, the other thing that's happened, of course, is that as we switch from central banks seeking to stimulate growth through pumping money into the system, that hasn't worked because it got into the banking system and didn't get any further. That's why we haven't had an inflation breakout, because the money didn't get out into the general community. The money went into the banks and then got used for buying stocks and real estate. So what we saw was asset price inflation. Well, now that we're starting to see a flip over to governments actually spending the money, then we're going to see two things. One, debt levels are going to rise even faster. And secondly, we're going to see an inflation breakout because that money is now going to get injected directly into the economy. And so I think finally, after all this time, we are going to start to see an inflationary breakout. Now, you might say, well, so what? That's interesting. Isn't that just economics? How does that impact me? And the impacts are really incredibly important. And the key message here is that investors simply must change their approach. And I'll give you one example to show why. Um, and the reason is that this is not just a matter of riding through some volatility, and the trends that have been in place for the last 5, 10, 20, 30 years will resume. And so all you need to do is just shut your eyes for a period of time and it'll all go back to normal. Right at the start, I said there are big picture cycles are changing on decade-long time frames. We've seen a 35-year bull market in bonds, therefore a 35-year decline in interest rates. That would appear to now be over on a big picture cycle level, and that means that interest rates are now probably going to be heading higher for a lengthy period of time. That could be, decades or more. Now, that doesn't mean they're going to rocket up all of a sudden, but it does mean that the trend has changed and that investors are positioned a certain way, absolutely need to rethink it. So let me give you an example. Just consider, and this would be the bulk of the population, just consider the low profile, the low risk profile investors that are out there, which are most people. They just want to get a return on their capital. They don't want to eat into their capital because they're looking now at, perhaps 20, 30, even 40 years of life after retirement. And so they just want to get a return on their capital and they don't want to risk it. So over the last 3 or 4 years, because of central bank policy, they've been forced out of bonds, which is where they were getting their 3 or 4 or 5% return, and they've been forced into equities to get a return which was adequate. And as a consequence, they didn't go into the general stock market across the board. They tended to go in stocks that were as most like bonds as you can get. And in the Australian equivalent, they were stocks like Transurban, Sydney Airports, Bunnings Warehouse Trust. There's literally tens of, probably even hundreds of them that fit into that category. So that's where they went. But many of these companies, not necessarily the three that I've listed there, but many of these companies carry large debt and have low growth in earnings. All they had going for them was that they paid a yield of 5, 6, 7, or 8%, and that's what attracted investors. Now, the problem is going to be that prices have already come down significantly, as we'll see in a minute, but it's likely with these big picture cycle changes that those prices are going to come down a lot further as the cycle progresses. I think this is just the start because people are now going to look at these and say, well, this is just not what I signed up for at all. So let's take a look at some examples in the Australian sense. So this is Transurban. Just apply the template there. So you can see Transurban had been in a very long-term uptrend. It was a yield play stock. It went from around $5, got up to $12. So investors were very happy. They got strong yields and they got terrific capital growth as well. The game has changed and we've seen very quickly the prices come off from around $12.60 and we're now down to around $10. And I think we've probably got a lot further to go. Now, this is oversold at the moment, so I'm not saying this is just going to fall apart. you are going to see a progressive de-rating of these stocks, I believe, over time. Let's look at Sydney airports. Same scenario. We've come off from $7.60. We're now down to $6. These are big moves. $7.60 down to $6 wipes out about 2 or 3 years of dividend payments. So people that bought into these stocks to get their dividend yield are now losing money on the capital value side at a very fast rate. Let's look at Bunnings Warehouse Trust, which has been, I guess, one of the real darlings for low risk investors. Got to $3.90 in August. Now we're down at $2.80. It's lost nearly 25%. That's the best part of 4 years of dividend payments. We are going to see a continued slide in these share prices over the medium to longer term. And I think at various points we're going to see some panic selling once the penny starts to drop with enough investors. It's early stages yet, and I believe there is quite a way to go. So it's for those reasons that I say that investors just simply must think about the approach they're taking. And if they're doing things by the old playbook, then you want to think about changing them pretty quickly. Now, turning to the American market, the S&P 500 rose just 18 points on the week. But look, a couple of key things here. Don't watch stocks. If you want to find out what's going on in the world, don't watch stocks. You want to watch bonds and interest rates, which is what I'm doing very, very closely. A top is coming in stocks. I've been saying that now for several years, but equally I've been saying it could be 5 to 10 years away. So I'm not trying to be a panic merchant here. This is just part of normal economic and financial cycles. This was always going to happen. And so there is a top coming. I believe the policies of Trump will accelerate the endpoints, but they still could be several years away. So, don't panic in that sense. I'm not trying to, scare you or anything here, but you need to know the facts. This is the reality. Now, the reason that I believe that we're not close yet is because there are still too many bearish people. You get a top in the market when everyone's all in, when everyone's turned euphoric and there's no buyers left. We are nowhere near that yet, and that's why I believe the US market in particular can continue to advance at the index level, quite possibly for another year or two. I don't really know. I'm making sure that I keep an open mind on timing, but I think it is absolutely inevitable that there will be a major top in the stock market, and we'll go into another bear market that will be of the equivalence of 2008 or greater. What we will need in the US stock market is a breakout to new highs, and that will snuff out a lot of the bears. It will start to get people bullish when we get a new breakout, and I think that's what would be required to move us to a more bullish sentiment. But at the moment, sentiment is still pretty ordinary. The other danger, of course, is that whilst we're not seeing big moves at the index level, we are seeing huge moves on a sector by sector basis, and we've seen a huge rotation. I've been talking about this for weeks now. In the US, it happened from the high yield utilities and telecom stocks, and we've gone into finance, defense, biotech, materials, and also industrials. So the rotation in America has been huge. Most sectors are now at short-term extremes. If they've been moving up, they're overbought. If they've been the ones that are being rotated out of, then they're at an oversold level. So I do expect some reversion to the mean in the short term. So very important not to go chasing those particular sectors at the moment. So let's look at the S&P just to start with. We'll start with the big picture. So you can see we're very, very close to all-time highs, and we are in the fifth leg of this bull market that started after the GFC in 2009. Leg 3 was by far the longest and strongest, as is always the case. Leg 4 tends to be a bit of a washing machine. This is a monthly chart, by the way. So this is the complex pattern that you normally get around a wave 4. And then we're in wave 5 now, which can be anywhere from short to reasonably long. You can see the trend channel is still intact, no question about that. And it's highly likely that the S&P index will continue higher from here, 2,300, 24, possibly even 2,500 points. I don't really know. I don't care. It doesn't matter. That's not the key point. The key point is that it's not what the index does. It's the sectors that you're exposed to that's so important. So there's the S&P. Not a lot of change in the week, but certainly a lot of change going on under the covers. You've just got to look at the Russell 2000. Remember, it was only two and a half, 3 weeks ago, I pointed to this breakdown in the Russell and said that that was significant and we needed to be very careful about that. Just look how it's changed. And this is yet another advertisement for the fact that you must be open-minded about the market. Yeah, have an opinion, but if you get an opinion and are determined to stick with it, that a certain thing is going to happen, it's absolutely to your peril. These days, a lot of things are occurring which just should not be happening. They're illogical, they are unsustainable, they don't make any sense, but they are still happening. And so you have to be flexible to move with them. So there's the Russell. The Nasdaq, by comparison, has struggled a little bit because of the rotations that have gone on. But look, as you'll see later on, I'm still a huge fan of technology. I think it's going to be one of the big winners of the next decade or more. And I think the opportunities that a sell-off in technology creates are some of the best that we'll see. Turning now to Aussie stocks, the Aussie dollar was down 7% to 73.4, so off almost 5 cents just in the last couple of weeks from the peak. And you've got to say now that sub 70 cents is now back on the table for the Aussie dollar. The index was down 10 points for the week, but as you know, I think the ASX 200 index is pretty much meaningless. Unless you are just a broad index investor. It was dragged down during the week by Australian resource stocks, and small caps remained under pressure. So our market is behaving nothing like the US market. The US market was very strong in banks, strong in resources, and obviously incredibly strong in small caps. And our market was not quite the opposite, but not far away from it. So quite a difference in performance. Let's just look at a couple of other key charts. We'll look at the US dollar. There's the US dollar index. It's absolutely blasted through 100, which was a key technical resistance level. So we've broken all these tops now, and you can see we've broken out, and the US dollar is just on an absolute tear at the moment. So we're now at levels that was last seen, you've got to go back to 2003. So we're at 13-year highs now in the US dollar. The US 10-year yield has also, as a consequence, as you can see, we did bottom out in July. So interest rates 1.34. We got up to about 1.8 before the US election, and now we've just absolutely spiked to 2.35, and the consequences of that to debt servicing, can't be overstated. It's really quite huge. Turning now to precious metals, gold was down by another $20, another ugly week for precious metals. But I did note that stock indices last week, gold stock indices were slightly higher. And as you know, stocks will lead in both directions. And so I read that as a bit of an encouraging sign. Now, the price of gold is responding to the higher US dollar. So the US dollar up, and that's putting downward pressure on the price of gold. And I think it's prudent to assume that that is likely to continue. So if we are hanging our hopes on the US dollar turning around, it might or it might not. I think it's prudent to assume the the worst case, not worst case, but the more negative scenario, and that is that the US dollar keeps rising. So if that's your starting point, I think that's prudent. So that means that for gold to move up, it will require one of two things to my mind. One is that we get an inflationary breakout, which is generally good for gold, and so people then start to flood back into gold. Or alternatively, we get some sort of fear come up for one of the number of triggers that I'll highlight in a minute, which overcomes the drag of the rising US dollar. So if we acknowledge that we're going to have a drag from the US dollar, then we need something that's going to more than compensate for that. And certainly history shows that that happens quite regularly. So just because the US dollar rises doesn't mean that it's all over for gold. But we will need an inflation breakout, or we will need fear. So the question becomes, what are the odds of some fear re-emerging? An important point. So let me ask you some questions to think about. Do you think Trump will wondrously transform America in a short space of time? Because that's what the market is currently pricing in. I think that's completely unrealistic for a whole bunch of reasons. Do you think investors are going to happily sit on trillion-dollar losses in bonds, which they've already accumulated in the last few weeks? These bonds offer almost no yield. They're almost certainly going to guarantee capital losses in an environment of rising inflation. Do you think investors are going to do that? I certainly don't. So at some point, I believe there'll be an accelerated sell-off in bonds, even more than we've seen so far, as people panic out of the bond market. Do you think European politics is going to ignore what happened with Brexit, what happened with Trump, or do you think that it's possible that the Italians will vote no to the referendum and that'll cause chaos there? The French could even put the right-wing party into power, which just really puts the cat amongst the pigeons as far as France's involvement in the Eurozone. I just think that maybe none of those things will happen, but I think the risks are rising and rising quickly. Countries that cannot service their debt, do you think that at least some of them are not going to default? And we've seen what happens when Russia defaulted in 1997. We saw the Asian currency crisis when we had defaults there, the turmoil that caused. Do you think that that's not going to happen again? So when I kind of look at, are there triggers out there for fears to re-emerge, which would be positive for gold? I can't put my hand on my heart and tell you they're absolutely going to happen, but gee, I've got to say that the risks of some of them happening are rising and rising very fast. So it may not be right now for gold, but there is a place in everyone's portfolio for gold exposure. There is absolutely no question about that in my mind. It's purely a question of balance. Now, some people took the bit between their teeth and just got way too exposed to gold. They didn't buy into the gold bull market in February when it was obvious that the tide had turned. Therefore, they didn't make the big gains on the way up. They only started buying in towards the end when they felt more comfortable. They've then been smashed in the correction because they had way too much exposure. So you can't afford to keep doing that. That's just a great way to rip up a lot of wealth. You've got to be prepared to get in early, perhaps sometimes when it's not at all comfortable to do so. You need to take profit, don't get too greedy, and don't overexpose to any sector. Now, yeah, the gold sector looked great, but that's not a case to put virtually all your money into it because that's where the big gains are. You've still got to remember about balance in your portfolio. Let's have a look at precious metals. So we'll start with gold first of all. So there's gold on a weekly chart. You can see we've now come back to a key level. It's around 1200. It forms this double bottom that we had here in June. I don't particularly want to see 1200 break, but look, if it did, it's not game over. It's still part of a basing pattern for gold that started in 2013. We had a bear market, and then gold has based out and has been basically forming this big base ever since. So if gold were to drop to 1150 or even 1100, it's not game over for gold at all. It just means that it's delayed what I believe is the inevitable because of what I've talked about in the first part of this video. There's the daily chart. So gold still falling over the last couple of days, and of course silver also off reasonably sharply. But when we go to GDX, for instance, as an example of what gold stocks in general are doing, you can see we did break this key support, but in the last week we're actually slightly higher. There's last Friday finished at 20.92, and then yes, just this weekend finished slightly higher. So gold stocks looking as though they're stabilizing. So I take that as a bit of an encouraging sign. Turning now to other commodities, copper slipped back a little bit. It was 252 last week, back to 245. That's really just in line with the rising US dollar. And as I indicated, we're heading towards a deficit in 2017-18 in the copper market, and that's going to be positive for copper stocks as a bigger picture statement. Don't rush out and buy copper stocks now because we've just had a very, very strong rise from 210 to 270 as a peak. So you don't want to go, chasing that right now. Crude oil all over the place last week, collapsed to 42 and then rebounded to 45 despite the US dollar strength. So some impressive things happening in crude oil and energy. And again, just supports my view that longer term, the energy market is a place where there'll probably be some advantage. There's the spot copper chart. So to wrap it all up, this is, I could probably talk for another half an hour here, but here's the key points. Do not chase hot sectors. And we've suddenly got some new hot sectors. And I believe the long-term trends there, because of the cycles, will probably continue. But that doesn't mean that you buy into them now. Let other people pay the short-term high prices. Wait for pullbacks. Demand lower entries. And if you can't get lower entries, then just be happy to sit in cash as a strategic asset. A lot of people are still hung up on the fact that cash is a perceived wasted asset. It's not. If it's there and it's earmarked to buy a high quality growth asset at a lower price, and that price drops 10%, then you've just made 10% on your cash. So you've got to understand the difference between wasted cash that doesn't have a purpose and cash that's sitting with a very strategic purpose in mind. I think you should expect volatility, even if stocks in general keep rising. I think we're going to see a lot more ups and downs. For me, the future winners at a big picture level, technology over the next 10 years, I think is going to offer some fantastic opportunities. Precious metals, whether it's next week or next year, for all the reasons and all the potential triggers that I talked about earlier. And of course, selected resources in a rising inflation environment are probably going to do pretty well also. There is an opportunity for those who are well prepared, and I just want to jump on the old soapbox again. These are the key things for me, is about clarity of purpose and about a very clear game plan for what you're doing. And most people are not remotely well prepared for changes in the market. Sector rotation will cause a lot of pain where the indices may not necessarily show it, and we're seeing that already. If you're in the wrong sector, you're hurting. If you're in the right sector, you're smiling. So don't just look at the indices. And these are all big picture rotations. They're being driven by the big economic cycles, the end of the 35-year bond bull market, etc. These are not short-term rotations, but in the very short term, they're overdone. We should see a little bit of reversals of the very strong short-term trends that we've seen. And finally, there is a really strong case to reduce your direct correlation with the stock market because of the volatility. There are always things that you can do. You don't have to be a victim. As an example, you can go into unlisted and alternative assets, which reduce. You can do that through listed investment companies, but you've got to be knowledgeable in this area. There's a whole raft of listed investment companies in Australia, and the majority of them have poor returns to investors. But there are some that offer great returns to investors. You've got to understand the difference, and you've got to also understand there's a time to buy and there's a time to not buy. Some of the best listed investment companies in Australia are disastrously overvalued. You don't want to buy them. They're overvalued because they've performed so well. But if you buy them at the current level, they're not going to perform for you. So, you need to be knowledgeable in this area. But the key thing is that you do have alternatives, and you really should focus on what actions you can take to both reduce risk and volatility while still leaving the door open for a decent return. And because of the opportunities, I still remain exceedingly bullish on the opportunities, but it's how you get into them. The fact that there's a great opportunity and a great long-term trend does not mean that you just go in and buy at any old time. There's a way to do this. So I'm absolutely of the view that you can still generate a well above average return, and you can do it in a way that reduces your risk and your volatility. But you're not going to do it by the old methods, that's for sure. So look, another long video, but things are just shifting so quickly at the moment. You need to have this perspective, in my view. There's my contact details for any non-members that want to get in touch with me, and I'm sure we'll have another very insightful week coming up. Cheers.